Okay, good morning, everyone. Thank you all for joining us this morning and following and allowing me to present the journey of alternative data. I appreciate the attention. You know, this is a pretty volatile market, and folks are actually coming in and joining, which is very humbling and appreciative. A quick background on Lucena. We are a leader in computational finance and machine learning. We connect leading data providers with buy-side investment professionals, and we help them extract actionable insight from big data. I'm Katz. I'm the co-founder, CEO, and I want you to know it's very important to us at Lucena here to expose as many people as possible to deep learning and data science, because I truly believe that in just a very few short years, this technology will be essential to staying relevant, especially in wealth management. This is a 30-minute presentation, and we will leave some time for Q&A at the end. I want to also introduce Catherine, who will be joining me here to collect questions, Q&A during the presentation. And depending on time, I will answer them live, or if we don't get to answer all your questions, I promise to follow up with answers and distribute those answers in the Q&A format after the webinar. So here's the agenda for today. We will discuss at a high level trends in alternative data and how it's being adopted in the market. We will then discuss the challenges of distilling substance from noise and how to validate alternative data. And then we'll spend some time on conditioning time series for machine learning research, particularly deep learning technology. And then I'll touch base briefly on how data is used in the context of deep learning. Again, I'm going to be very high level because I have a whole new presentation that I've done about 2 or 3 months ago that goes much in more detail into the deep learning application for stock forecasting. And finally, I'd like to showcase a few automation tools we've developed here at Lucena that provide some of these empirical evidence of how effective or predictive is alternative data. So unless you've been living under a rock, the trend is moving rapidly in favor of quantitative investment using big data. So according to alternativedata.org, buy-side, hedge fund analysts and other investment professionals have been raising their spend since 2016 by over 280%. And we estimate total spend by 2020 of above $1.7 billion. So this rapid growth of Quant Fund, which now owns more than 50% of the hedge fund universe, is exemplified by the shift in market share that you see on the right chart here. Needless to say, machine learning is transforming rapidly, and the enormous inflow of predictive data is becoming more increasingly important to find ways to automate the validation, enhancement, and deployment of such data. So the advantage of applying the same quantitative principles and research approach to data validation and for investment decision-making. In other words, the same technology can be used in the context of data validation as well as actual deployment of such information for investment decision-making, because you want to train and validate the data in the same informative fashion to the context of how it's going to be used for investment decision-making, whether to predict KPIs such as total sales or growth margins, or gross margins, or to predict an asset impending price action. So that's kind of the research. And again, we apply the same technology to both sides, validating data and qualifying it for investment, and to the other side for the professionals who are using the data to make informed decisions. So let's talk about big data and financial big data, and it can be broken into the following 4 categories. There's a traditional, technical, fundamental, and market, global macro data. These are things that have been around for a long time. This is not new, but still being used in the context of research. So it's an overlay of what we've done historically before. Even if you are a deep value, bottom-up, fundamental shop, you would use these type of informative information about assets to make decisions. Now you have the equity-specific alternative data. These are corporate actions, 10Ks, 10Qs, for example, or insider buying and selling, or options-based max pain analysis. These are specific to assets, but they are not the traditional technical and fundamental. These are, unique data sets that are, again, informative as an overlay to the research. And then you have a very strong trend that we see happening with very large providers that have traditional businesses that are not financial data necessarily. They collect data that is for other purposes and is being repurposed now for finance. Think about weather data, location data, credit card transactions data. This is all informative, very informative, but was not really purposely or purposefully collected for the financial market. And then the last category is unstructured data, which is basically free text or speech forms or other digitized kind of unstructured format that with skilled NLP technology, natural language processing, you can digitize the technology and transform it to a structured data mapping that can be associated with security or universe of assets. For example, look at news feed sentiment, social media sentiment, earnings call transcripts, and others like that. So with such disparity of big data types and sources and no industry standard, it's becoming increasingly important to form a common baseline. Specifically, the goal is to store all data in a uniform, normalized fashion that's distributed evenly across multiple competing assets so we can compare one to each other. So in a perfect world, different data could coexist and multiple orthogonal signals can form predictive information by creating a composite sentiment score that is inherently more predictive than each signal on its own merit. It turns out that such multi-factor model is a perfect task for machine learning, and ultimately our goal is to classify which data elements together are most suitable for investment. But more on that a little bit later. Okay, so many of the funds that we work with are looking for ways to fail fast. They're looking for ways to save precious quant research time on unqualified data, not to mention rely on false assumptions when they actually deploy such data. So the solution is to establish a well-regimented process, preferably by an unbiased third party who is not the actual data provider, right? And to effectively validate the data set's authenticity and predictive power. It's important to note that the process of data validation is somewhat similar to the process of constructing an algorithmic investment strategy. So again, we can use the same technology to do both types of research. So we broke down the validation process to 3 distinct phases, phase 1, 2, and 3, obviously. Phase 1 is the initial assessment for consistency and completeness. This is really where we don't really apply machine learning at all there. This is done on the entire data set, and it is really intent to form the baseline whether the data is ready to be further tested. In phase 2, we actually create what we call model construction, the training and the cross-validation. This is the phase in which the lion's share of the machine learning technology is applied. And in phase 3, we do what we call the validation backtesting and robustness testing. This is how we ensure minimum risk of overfitting and unsubstantiated results. And I'm going to talk more about that in a little bit later. Okay, so it's very important to be disciplined by which we can break down the data analysis periods into distinct timeframes with strict no overlap or no peaking rules, right? It's important to make sure that we don't overlap the time frame in which we do various testing of the data, and I'm going to explain more about that in a little bit. In phase 1, again, performing the entire data set. This is just testing for symbology mapping, missing data, NANs, which is missing information on certain trading days or non-trading days, excessive signals that are conflicting with each other, distribution of how signals are broken down between multiple assets in the universe, and of course we test heavily for survivorship bias and the likes. In phase 2, where we break down the time frame into distinct training, validation, and holdout period, you can see here in different colors, the training period, subsequently a validation period, no overlap there. And then there's another period called the holdout period. And ultimately, we do what we call a forward testing on unseen time frame into the future. So it's very important to do those steps and ensure that the model that you are identifying as you validate the data actually persists in strength throughout all these time frames. So let me explain a little bit more about how it goes. We basically embark on a highly iterative process by which AI is deployed to repeatedly construct models and test them subsequently. We repeat many, many thousands of times the process of constructing a model and training it on a subsequent time frame. So there's no cheating. There's no overlap between the training and the testing. And then we validate them out of sample. So you can see that the process between the blue line here and the reddish pink line to follow repeats thousands and thousands of times until we get a consistent model that behaves consistently. But then we test the data or the same process on a holdout time frame, which is completely unseen data, and see if it still holds the same relevancy. Now, the reason we are retraining the model multiple times and validating multiple times, as opposed to only training once and only validating once, is because the market that we are trying to deploy machine learning for is a non-stationary problem. In other words, it's dynamic. It changes all the time. The regime changed, the risk changed, the investors' behavior changes. So you need to adjust automatically per se or regularly per se to the market conditions as they change. And that's why we kind of repeat the training and validation process, and we test them against multiple market regimes. Again, there's no overlap between training and validation. It just repeats over time multiple times. And then, of course, you repeat the same process on yet another time frame, and of course, during the holdout, as well as when you go into the future. So you can see here, we have developed, and again, every data validator should have some sort of a backtesting simulation that is robust enough and accounts for all the things that a simulation should be accounting for, including slippage and transaction costs and all the things that go into backtest simulation to ensure that we are not unfavorably or unfairly providing false positives on the data. And of course, repeat the same process into the future on a perpetual go-forward basis. So this is paper trading simulations. It's not really real money, but it's basically simulating informed decisions based on historical data. You never know what's going to happen in the future, and you see if the same model that you've tested and validated during the training, validation, and holdout keeps performing well into the future. And if it does, you have a pretty good confidence in the data itself. Okay, let's talk a little bit about feature engineering, because this is an important stage in which we take a lot of time and thoughts. And essentially, while looking to build models for active investment, let's say 1 week to 3 months, and of course, for some extent, longer-term decisions, quarters or years, the research process attempts to identify abnormal behavior that significantly deviates from a forecasted behavior. You see, the assumption is that if you have a forecast, an expected behavior, it's already built into the price, because we have a very efficient market that responds to information very, very quickly. So in order for us to be able to identify information in the data, we have to look at what we call observed versus forecasted, that the observed information deviates significantly from what is being forecasted. And if it is, we have an idiosyncratic situation that can be acted upon to act upon. So what you see on the slide here is a chart of total retail and food services monthly trade volume over time. This is 1992 all the way to present. There's a clear seasonality in the data. You can see that it kind of behaves very similarly over the course of the years. We'll get to that in a second. But there's also some kind of a bias over time. You can see that the values kind of increases even during that seasonality. The reason we see that bias over time is twofold. Number one, economies grow. People spend more money on food and retail over time. So that's a natural behavior of the market regime. But also, we've gotten better in collecting information and data over the years. So there's some sort of a bias that's not necessarily a relevant bias to the activity that we see in the market. That is just because we are collecting data more efficiently in more recent years. Also, there is quite a bit of noise in the data. You don't see it here, but if you think about capturing daily data, between days of the week, Sunday or Saturdays, weekends are much more active than during the week. That's going to create some kind of a noise in the daily data that you have to account for. You need to smooth the data over time, right? This is the idea of creating some kind of a forecasting by smoothing it over time. You can see here a more focused, detailed view of the same chart as we've seen before, and you can see how as we get to the holiday seasons, how the spending kind of jumps pretty high regularly, and then it jumps right back down as we begin the next year, the following subsequent year. So the seasonality is very clear and very real here. And one of the approaches to identify, the forecasted observation of the data is the naive approach, which we say, the same value that we have today, assume that it'll be tomorrow, or the same value that we have this month, assume to be the same value next month. And that's going to be what we measure deviation against. Well, it turns out this is not a good way to do it, because data is very noisy. You can see clearly on the screen here, if I forecast here that the next month value will be the same, I'm going to fail miserably in forecasting the proper value. So essentially, we need some smoothing algorithms. And you can see that moving averages is one of the smoothing mechanisms that being used. What you see on the screen here is a not very effective moving average. It's an expanding window with simple moving average. You can see that over time, as time grows, the values deviate more significantly from the actual observed values. So we can apply what we call a simple rolling moving average. It gets much closer to the actual target. But if we measure the error, which is basically the forecasted against the observed data, there is a clear way. There's an industry standard of doing it. It's called root mean square error. The values are still fairly large in this particular data set. So we need to find another way to de-season or normalize the data to account for these fluctuations that are kind of repetitive over time, but are not going to be carried very clearly from one time frame to the other. You see, a moving average takes an equal measure of the historical time value. So basically, if you have a 30-day moving average, the impact of day one to the average is the same impact as day 30. And that basically creates a higher than expected or desired mean square error. So one of the ways to do that is to apply an exponential weighted moving average, in which we assign a higher degree of relevance or more weight to the most recent data points, and still want to consider the historical data points, but with less relevance. Again, using root mean square error to measure the distance between forecasts and observed results, the values are still too large to make informed decision. So a better method is to get closer, is truly to minimize the RMSE, root mean square error. And there is a technology or model that's built actually in the 50s, I think, by Holtz. It's Charles Holtz, who actually was an MIT, University of Chicago graduate, who later became a professor at Carnegie Mellon. And he developed actually a 2 exponential moving averages that kind of compare against each other. And later on, a gentleman, his name is Peter Winter, who actually added a 3rd exponential moving average. So all 3 are used together in the context of forecasting a repeatable, historically repeatable seasonal time series. It's called the Holtz-Winter model, or in more scientific terms, triple exponential weighted forecasted moving average. And you can see here on the screen that we are getting really nice and close. And this is what we have seen have worked really well to minimize, again, to de-season the data and remove the biases to create some sort of a forecasted value. Now, again, remember, what we're doing here is trying to forecast value and see how the observed value deviate from that. And that's a significant indication or a signal that something, is happening that is not, forecasted, and therefore we can act upon it to inform this decision. So the way it works with machine learning is we're trying to generalize that information over time and trying to classify a time series state, is what you see here, time series state that historically forecasted an outcome with high degree of accuracy. So you feed the machine with lots and lots of examples of data that has been, again, normalized and forecasted as it was observed, or has had some deviation, and you basically sign or feed or inform the machine of what the outcome was for each situation on these assets. And the machines start to generalize kind of what are the states that are more informed for repeatable abnormal behavior that can be acted upon, can be exploited. So I won't get to the specifics how the machine works. I have a whole separate presentation about that I've done a few months ago. It's on our YouTube channel, but I want to touch on 2 slides just to give you some flavor of what's happening behind the scene. What you see here is an image classification. This is not new. It's been around for a long time in production. If you look at the autonomous vehicle, Facebook tagging, Amazon purchase habits recommendations, and a whole variety of other technologies are using this classification technology. It's a convolutional neural network that essentially gets image or a picture or some graphical depiction of a state and identifies what it is. And it uses multiple layers to identify and break down the information so it's easier for the machine to consume and classify that this is a bird, a picture of a bird. The way it works, it does not have to remember every image of a bird and compare one against each other. It generalizes some of the factors that make a bird be a bird. And in essence, that's the convolutional neural network process. So I'm not going to get into the specifics here, but that's kind of how it works. And the question is, can we apply the same principles to the stock market? So again, our goal is to find time series data that can be creating a state that the machine can identify as a predictive signal. And again, as you looked at how we created those factors, those derived feature engineered factors, we can overlay multiple factors against each other and see how the machine generalize what's abnormal and what's really informative for a buy signal, as an example here. So that's kind of how the process works, and that's how we apply some of the information to kind of create model portfolios or investment strategies. Okay, so I'm going to touch really briefly on some of the tools that we built here to automate a lot of the things I just talked about, because as you can see, it's a pretty involved process. You need to know what you're doing, and you need to be able to automate many of those mundane tasks to really move swiftly with lots and lots of data and really identify what's really worthy of further research. So we build the following capabilities. One of them is called DQE, which is data qualification engine. Essentially, you upload a CSV file and you create very quickly a report that the data is really ready for prime time. It checks for all the NANs and the survivor bias context of the data and see how the signals are distributed among deciles and quintiles and a whole bunch of stuff. It's a pretty robust report. So this is the first thing we build, and actually it's very easy to use. You upload a CSV file, you push one button, and it comes up with this amazing detailed report. The other piece that we built here is something called data matching engine. And this is really a powerful AI technology. So once you validated the data and you create the features in our platform, you can actually go through a wizard and upload your portfolio or a fictitious portfolio and answer a few questions about your investment style. Are you highly diversified, highly concentrated, time period of holding that you wish to associate. And it's going to go and sift through all the data sets and identify which one is most suitable for you. So that's another technology. Again, it's a very simple process. You go through about 4 screens of questions and answers, and you press a button, you get a report of which data set and which factors are most suitable, and it gives you a results. Why do we think these are more suitable than others? It has back testing, event study graphs, and the likes. The data review sheet is a little more detailed by a visually compelling synopsis to showcase the data in the most relevant way to multiple investment objectives. Again, it's a report that we generate from the data. And of course, we have a very comprehensive backtesting and model portfolios to showcase how the signals behave on a perpetual basis. So we'll be happy to show you more details on how these things work at a later time. But again, they are fully available, professionally available, and automated to the degree that we can automate these processes. One last thing I want to mention, we have a platform called Wandesk, and we have a bunch of tools that allow you as a user to quickly identify a whole bunch of machine learning disciplines on data, whether it's forecasting, event signal processing, optimizing, hedging, and the likes. And that's kind of what I wanted to showcase today. Obviously, we don't have time for a deeper demo, but this is kind of the process I wanted to share with you today, and ready to answer any questions if you have any. Catherine, any questions?
It looks like we haven't gotten that many coming in. So if people have any that they've thought of that they want to include, and they can either do it in the chat box or in the Q&A portal. We have about a couple minutes left that we can review some questions.
Sound like we were very clear, and everything was pretty informative. So if there's anything else that I can answer, or any of our quants can answer, I think we have some questions in the chat here that I'm seeing here.
Yes, we got a question that said, "Is this available for private investors?"
It's a fair question. We actually have. So most of our customers are enterprise customers. We do have a few sophisticated private investors that are able to use our technologies. So happy to have you talk to our sales staff and send me an email. I'll forward it to our sales representatives, and they'll try and help you out. Somebody is asking about what have you seen from satellite data? Yeah, we've seen actually multiple technologies from satellite data. There's some great data providers. I'm not going to make it an advertising kind of platform, but there's great platforms for satellite imagery and very advanced technology that allows you to identify, again, parking lots and maritime activity. And of course, don't forget the location data is very big as well. How do you identify the cardinality, the size of the audience in square miles in the US or in the world that can result in substantive information on the economic activity of these business units that are in that location. So Disney World, for example, or Walmart, Starbucks, whatever that may be, can be very informative in the context of future decisions on sales, KPIs, or even price movement. Okay, somebody's asking, Suresh is asking, if you adjust your models over time, how often do you adjust them? Yeah, that's a good question. So one of the things that we always do during that cross-validation, between training and testing, is identify what is the time frame to retrain your model. Is your model worthy of just staying put for a few months, or should you reevaluate the model every day or every week? And there's also a dynamic way to evaluate the data. So you can basically create for the model. For example, if your model can be evaluated, how effective it is, what is the accuracy or the precision of those decisions historically over time, as you move over time, you can actually say, okay, if my precision falls below 50%, I need to readjust my model. So it can be very dynamic, or you can test it out on evaluation, whether you should change it or not more often to create that kind of dynamic adjustment to the market conditions. So thanks for that. It's a good question. Yeah, go deeper into relevance of DRE, the visual synopsis. That's a good question. I think Taylor, one of our quants, is here. Maybe you can jump in, Taylor, and talk about how do we measure relevance of a factor or a data set for a given scenario or asset universe.
I think for that statistic, we're mostly looking at the IC chart. That's part of the DRE. So we'll look at, it's taking a very top level view. So it's not actually training a model. It's more just looking to see if there's a direct correlation between, and it's looking at linear correlation, right? So it's not building any sort of complex relationship. And it's looking at end day returns. So we'll look at 1, 5, 10. We'll look all the way out to a whole entire year later. And then that relevance score is, I believe, some sort of average of the IC values, the correlation values. So if it sees a positive or negative correlation, relevance, is like sort of like an absolute value of that. And if no future returns are correlated, then it gets a low relevancy score.
Yeah, thanks, Taylor. And again, we are an open book. We're not necessarily, we want to make sure we are very clear about how we go about doing things and how they work. This is not one of those secretive organizations that try to keep things kind of close to the vest. Our secret sauce is how we implement things, but we want to make sure people understand how they work. So happy to get you to go deeper as needed. Somebody asked a good question here. How do you validate an alternative data program that's provided as a black box? So it's John Davey. Thank you for that. So when you say black box, you mean, I assume you mean this is a source that has not been quite identified. So you have data, and we don't really know where it came from and what's the purpose of the data. I mean, that's totally fine for us. We want actually to know less about the biases of what the data is supposed to be done, supposed to be purposed for. We want the machine to identify, how good it is, how to classify it most effectively without human bias. So in many cases, that's definitely the case. The only time we would ask to see some relevance to the data is in the context of feature engineering. If we have to do feature engineering, we have to understand, what is the context of the data, so we can apply some smarts into how to create features that are going to be more informative of the data. But even for feature engineering, there's something called autoencoder with Q-learning. It's another form of machine learning that basically creates features on the fly for you from the data. And that requires no human intervention whatsoever. So again, for the most part, black box as a source of the data is fine as long as we don't have to apply feature engineering. I have another one from Suresh. Thank you for that. Let me see. He says, we build models both ways, but the DRE report, that's an answer. That's Catherine answering the question to Suresh. Let me see if there's any other questions from anyone else here.
Erez, it looks like Lee asked, what statistic is used to determine features?
What statistics to determine if features are predictive or not? Is that the question? I assume that's the question. So we have an interesting classification technology. So think about event study. An event study is basically technology that allows you to identify a signal that is an optimal time for an entry or an exit of an asset if you're looking at price action. With KPIs, there's other correlation, against the historical total sales or reported gross margins, whatever that may be. But let's talk about prices of assets because it's easier to explain. The technology basically identifies which factors, which features, and what are the screening criteria, min-max threshold, that you can apply against a universe of stocks to see which ones come on the radar as optimally a buy signal. So for example, a P ratio, just a filter or a scan, which everybody's using nowadays. The technology though, what becomes more sophisticated is to identify out of 950 factors, which we currently have in our database, which factors are most useful to create a predictive scan. So if you scan today for a P ratio between 10 and 12, which is below the market average, maybe not based on today's performance, but let's assume that it's below the market average. It's a good entry by any fundamental researcher that if you have a low PE, means the stock is undervalued, it's gonna go higher. But the question is between 10 and 12 the proper range to find which stocks I should buy today? So how do you do that? You can go back in time and identify historically through this technology called event study technology, which stocks came on the radar and how they behaved into the future. Again, technology we built allows you to identify which factors together and what thresholds should be the ultimate scan to identify an entry or an exit for assets in the universe. That's one of the methods that we use to evaluate if a feature is predictive or not, by basically minimizing the universe of features to select from to a subset of one data provider and see, okay, for that data provider's features, can we create a predictive models that test out of sample effectively if we actually act on these signals in a different time frame than we've tested the signals to create the model. I hope it was clear enough to provide you with more information. I'm happy to talk about it more after the offline. Catherine, any others?
I think that's all.
Wow, fantastic. Well, thank you so much for joining us. It's a volatile day, volatile time in the market. So I appreciate your time and your interest, and happy to again respond to other questions offline if needed. Have a great day and happy holidays to everyone.